welcome to the Deep Dive. Today, we're tackling something a lot of you ask about. Really getting a handle on the stock market without getting totally overwhelmed.
Yeah, it can feel like a lot.
Exactly.
Okay.
So you sent us John L. Person's book, Mastering the Stock Market, High Probability Market Timing and Stock Selection. It's from 2013.
Right.
And our mission today, let's pull out the key strategies, the actionable stuff that can give you a clearer edge. Skip the super dense jargon.
Absolutely. And this isn't just theory, right? John Person, he's been in the trenches, floor trader, broker, analyst. He's seen a lot, tested a lot.
That experience matters.
It really does. And one thing he mentions is this kind of long-term bullish view he's held really since the 2009 bottom.
Oh, interesting. Why?
Well, he points to things like tech advancements, globalization, just the basic drive for prosperity. So his strategies are kind of built on this idea that overall the market trends up.
Okay, so that's the backdrop. A generally positive long-term view.
Yeah.
But then he gets into active strategies.
Exactly, which is what makes it useful for our listeners looking for those aha moments.
Right. Practical techniques for timing, for picking stocks. Let's dive in. Where does he start? What's the core approach?
He really advocates for a top-down approach. Start big picture.
Big picture.
Like the overall market first. Think S&P 500, NASDAQ 100. Get a feel for the whole trend.
Okay.
Then you narrow it down to sectors. And only after that do you start looking at individual stocks within those sectors.
Like focusing a telescope, you said.
Exactly like that. And tied into this is something pretty interesting, seasonal analysis.
Seasonal analysis. Tell me more about that. What does that mean?
Well, the core idea is that certain sectors, maybe even specific stocks, tend to show predictable price patterns during certain times of the year.
Predictable. Like clockwork.
Well, not quite clockwork. It's crucial to remember, unexpected events can always throw patterns off. The book even mentions companies that didn't adapt and failed despite seasonal trends.
Okay, so it's not guaranteed.
No, but it's about tendencies. Historical patterns that might give you a bit of a statistical edge.
Okay, I think I get it. Can you give us an example, something concrete from the book?
Sure. He looks at the retail sector ETF, XRT.
Right.
Historically, it tends to show a smaller dip, a minor low, somewhere between July and September. Then a bigger annual low often forms between November and April.
Okay. So knowing that, you might look for buying opportunities around those times.
Potentially, yes, either in XRT itself or in individual retail stocks. Or another example he gives is brokerage stocks. They often do well from October to May.
Which kind of makes sense, right? More trading activity then.
Exactly.
Yeah.
It aligns with when the market is often busier.
You mentioned a table 2.1 in the outline. What's in there?
Ah, yes, that table's pretty useful. It summarizes historical performance looking back 3, 5, 10 years when the book was written, and it lists typical buy and sell months for major sectors.
Like which ones?
Oh, XLY for consumer discretionary, XLP for staples, XLE for energy, XLF for financials. You get the idea. So for XLE, the energy ETF, it historically showed a potential buying time around early February, maybe February 3rd, and selling around late August, say August 22nd.
Again, not hard rules, but tendencies.
Precisely. Tendencies to factor into your overall analysis. Don't trade just based on the date.
And does this work for individual stocks too, or just sectors?
It can, yeah. He uses Sunoco, ticker SUN, as an example in energy.
Okay.
And its historical seasonal chart, which is in the book, looked quite similar to the pattern for the wider energy subsector and the main XLE ETF.
So there's a correlation.
Right. And that correlation is key. If a stock tends to move with its sector's seasonal pattern, that pattern becomes more relevant for timing trades in that specific stock. Look for entries in strong periods, maybe take profits in weaker ones.
Okay, so we've got this framework. Top-down, seasonal patterns. What's the next piece of the puzzle he brings in?
Well, then he talks quite a bit about exchange-traded funds, ETFs.
Right, ETFs are everywhere now.
They are. And he sees them as a really practical tool for actually using those top-down and seasonal ideas. They're kind of a hybrid, right?
How so?
You get the diversification of a mutual fund, but they trade easily like stocks.
Yeah, that flexibility is a big plus. What specific advantages does Person highlight for his strategies?
Several things. First, diversification, like we said.
Right.
One ETF covers a whole sector or index, spreads the risk. Second, the trading flexibility. You can buy and sell them throughout the day, buy on margin, even sell short if that fits your view. Much more flexible than traditional mutual funds there.
And costs.
Generally lower expenses, he notes, and potentially better tax efficiency, too.
So tying it back to the seasonal idea, instead of trying to guess which energy stock will do best in say, February.
You could just use the XLE, the energy sector ETF.
Right. Captures the whole sector's potential move.
Exactly. It simplifies things. You're playing the sector trend, the seasonal tendency, without needing to be a perfect stock picker within that group.
Okay, that makes sense. So framework, tools like ETFs. What about mindset or other overarching principles? You mentioned contrarian investing,
Yes, this is a really important theme in the book. He's a big believer in the contrarian approach.
meaning going against the crowd.
Pretty much. The basic idea is, if everyone is wildly bullish and has already bought, who's left to push prices higher?
Good point.
So extreme sentiment, whether it's super bullish or super bearish, can actually be a signal that the market might be about to turn. The crowd is often wrong at extremes.
Okay, but how do you, measure that sentiment? How do you know what the crowd is thinking?
He points to a couple of specific resources. One is the AAI Sentiment Survey. That's the American Association of Individual Investors.
Oh, yeah, I've seen that.
You can find it online. It gives you a weekly read on whether individual investors are bullish, bearish, or neutral about the market's short-term prospects.
In extreme readings, there could be a contrarian flag.
That's the idea. Unusually high bullishness might signal caution. Unusually high bearishness might signal opportunity from a contrarian view.
Interesting. And the other one was the COT report, Commitment of Traders.
Yes, the COT report. This one's from the government. It's free. It shows the positions held by different types of traders in the futures markets.
Futures, okay. How does that help with stocks?
Well, it's especially useful in commodities, he notes, because that's often seen as a zero-sum game. But the principle applies more broadly. You can see how the big players, the smart money, large commercial traders, are positioned versus the smaller speculators.
And the small speculators, they're often wrong.
The book shows some analysis from 2010, 2011, where, small speculators in the COT data were frequently positioned on the wrong side of major market moves.
So if you see small traders all piled into one side of a trade in the futures market,
That could be a signal the smart money is leaning the other way, and maybe a reversal is coming. It's another piece of contrarian evidence.
got it. Okay, so that covers market timing and sentiment. What about managing risk? Options came up in the outline.
Right. He talks about options not just for, speculative bets, but as really important risk management tools.
Risk management, how?
Well, he makes the point that just buying and holding stock isn't risk-free either, right? Especially around things like earnings announcements.
True, earnings can be wild.
Exactly. So he gives an example with Google, GOG, back in 2012. Stock dropped hard after earnings.
Okay,
An investor holding Google could have bought put options before the announcement.
like insurance.
Precisely like insurance. The puts limit your downside if the stock falls. And because it was a known event, the earnings date, he suggests you might not even need expensive long-term options. A shorter-term weekly option could have done the job just for that specific event risk.
That's a smart way to think about it.
Yeah.
Temporary insurance for a specific risk.
Cool.
Any other option strategies for managing risk?
He briefly touches on things like stock replacement, using calls instead of owning stock outright, maybe freeing up capital, and caller strategies too.
Dollars.
Yeah, where you own the stock, buy a put for downside protection, but also sell a call option against it to help pay for the put. Limits upside, but defines your risk. The main point is options offer ways to actively manage your risk exposure.
Okay, very useful. Now let's shift gears a bit to the more technical side of things, chart analysis. The outline had a big list, moving averages, candlesticks. Where does he start?
He starts with the basics, the foundations, really. Moving averages are definitely in there.
Standard tool?
Very standard. They smooth out prices, help you see the trend, look for signals like crossovers between short-term and long-term averages, just filtering out the noise, basically.
Makes sense. What else?
Candlestick patterns, he spends quite a bit of time on these.
Ah, the little rectangles and lines.
Exactly. They show the open, high, low close for a period.
Yeah.
White candles mean the close was higher than the open. Black means the close was lower.
Bullish and bearish.
Right. And he emphasizes that the main body of the candle, the rectangle part, is generally more significant for gauging buying or selling pressure than the wicks or shadows.
Okay. And gaps. I saw breakaway measuring exhaustion gaps mentioned.
Yeah, gaps are important signals too. A breakaway gap might kick off a new trend. A measuring gap suggests the trend might continue about as far again.
And exhaustion.
Exhaustion gap could signal the trend is, well, exhausted, maybe near its end. He also talks about a specific formation, the three-gap pattern.
3 gaps.
Yeah, sometimes seeing 3 distinct gaps in a move down can hint a bottom might be forming, though he cautions you usually want confirmation, maybe like a doji candle. Island reversals, too, those are strong signals.
Got it. And wedge patterns. Those can be on price and volume charts.
Correct. Wedges where trend lines converge can show up in price, but also on volume indicators like OBV, on balance volume.
Yep.
And a breakout from a wedge, especially if you see it in both price and OBV, can be a pretty strong confirmation signal for the direction of the move. He uses Freeport-McMoran FCX as an example where an OBV wedge breakout came before the price really took off.
Okay, let's dig into that OBV a bit more. On balance volume. How does it work? Why is it useful?
So OBV is a running total. On days the price closes up, you add the day's volume to the total. On down days, you subtract the volume.
Simple enough.
Simple calculation, yeah. The OBV line then ideally moves with the price trend, confirming it, but the real power comes from divergence.
Divergence, like when they don't match.
Exactly. If the price is making new highs, but the OBV line isn't, it suggests the buying volume isn't really there to support the move. It's a potential warning sign the trend might be weakening.
Oh, okay.
He shows an example from the 2009 rally in the SPY ETF. Price was going up, but overall volume was kind of weak. However, the OBV line was trending higher, suggesting there was underlying accumulation, buying pressure, despite the lower overall volume.
So it can give you a different perspective than just volume bars.
It can, and sometimes you even see classic chart patterns like head and shoulders forming on the OBV line itself, maybe warning of a top before the price fully rolls over.
Fascinating. Okay, what about other ways to measure the market's internal strength? Market breadth.
Yeah, he talks about the advanced decline line, the AD line. Pretty standard breadth measure.
How's that calculated?
It's just a running total of the number of stocks that went up minus the number that went down each day.
Okay.
And again, you look for divergence. If the main index, like the S&P 500, is hitting new highs, but the AD line isn't keeping pace or is actually falling, it suggests fewer stocks are participating in the rally. The strength isn't broad-based.
A warning sign.
Potentially, yes. He also makes a good point about looking at equal-weighted ETFs sometimes.
Equal weighted, like QQEW for the NASDAQ.
Exactly, because in cap-weighted indexes like the regular QQQ or S&P 500, a few giant stocks can pull the whole index up, even if most stocks aren't doing well. The equal-weighted version gives every stock the same influence, so it can sometimes give a clearer picture of true market breadth.
That's a subtle but important distinction. What about the ARMS index, also mentioned?
The ARMS index, or KIRNN, it's a bit more complex. It compares the ratio of advancing stocks to declining stocks with the ratio of advancing volume to declining volume.
Okay, so what does it tell you?
It's another way to gauge buying versus selling pressure. The book suggests looking at moving averages of the ARMS index. When it moves towards more neutral levels after being at extremes, it might sometimes signal a potential market bottom is forming.
Another tool for the toolbox, we're definitely building one. What about momentum? Stochastics and MEXCD.
Right, momentum indicators. Stochastics are oscillators. They move between 0 and 100, basically telling you where the current price is relative to its recent range.
Yeah.
Used to spot potential overbought or oversold conditions. And MEXC, moving average convergence divergence, that looks at the relationship between two different moving averages of the price. It helps spot changes in momentum and potential trend shifts. Both are pretty common tools for gauging the speed and sustainability of a price move.
Got it. So we've covered trends, reversals, volume, breadth, momentum. Now, pivot points. How do they fit in?
Pivot points are calculated price levels based on the previous period's high, low, and close. They're used to project potential support and resistance levels for the current period, could be daily, weekly, monthly pivots.
So levels to watch where price might react.
Exactly. Traders watch them to see if price respects them, maybe bounces off support or gets rejected at resistance. They can help confirm trends or identify potential entry-exit spots.
Any specific type of pivot he highlights?
Yeah, he finds the monthly options expiration pivots particularly interesting.
Options expiration pivots, not just calendar month pivots.
Right. He suggests these specific pivots, calculated around options expiry week, can sometimes be surprisingly accurate at forecasting key support and resistance levels for the coming period, maybe even more so than standard monthly pivots.
That's very specific. Worth looking into. Now, the market's changed a lot since 2013. High-frequency trading, HFT. How does the book address that?
It acknowledges HFT mainly regarding its impact on volume.
How so?
Well, HFT and algorithmic trading obviously boosted overall daily trading volume significantly.
Right.
But paradoxically, he notes, on really volatile days, HFT might actually reduce transactions sometimes as algos pull back or adjust very quickly.
Interesting.
He also mentions the factors algos look at: order speed, price levels, bid-ask spreads, momentum. The main point for traders using volume indicators is just to be aware that a big chunk of modern volume is algorithmic, which might affect how you interpret traditional volume patterns.
Good context to have.
Okay.
Okay, finally, let's talk about probably the most important part, trading psychology and risk management.
Absolutely critical. He really hammers home the need for emotional discipline.
Fear and greed.
Fear, greed, overconfidence, all of it. You can have the best system, but if your emotions run the show, you're likely to fail. Discipline is paramount.
And risk management.
Huge focus on position sizing. Knowing how much capital to risk on any single trade based on your account size and risk tolerance.
Like the 2% rule.
Yeah, he mentions that kind of rule, risking only a small fixed percentage of your capital per trade. It's about survival, staying in the game. He also introduces ATR, average true range.
What's that for?
It measures volatility. You can use ATR to help set more objective stop-loss levels based on how much a stock typically moves, rather than just picking a random percentage or dollar amount.
That makes sense. Tailoring your stop to the stock's behavior. What else on risk?
Just briefly covers order types, market limit, stop orders, when to use each. But the bigger picture message is about setting realistic goals, practicing, and really learning from your trades, both wins and losses. It's a skill you hone over time.
Absolutely.
Yeah.
Okay, this has been a really thorough look at John Person's approach. Let's try to summarize the key takeaways for our listeners.
Yeah, let's do that. So first, that structured top-down approach, right? Market, then sector, then stock. And layering in those seasonal tendencies.
And using ETFs as a flexible tool to actually trade those sector views or seasonal plays.
Definitely. Then there's the whole contrarian mindset, paying attention when sentiment gets too extreme, using tools like the AAII survey or the COT report to gauge that.
Right, looking for clues when the crowd might be wrong.
Yeah.
We also talked about options not just for speculation, but strategically for risk management, hedging around earnings, for example.
Yep. And then the whole technical toolkit. Moving averages for trend, candlesticks for patterns, OBV for volume confirmation, AD line for breadth.
Pivot points for support resistance, understanding HFT's impact on volume. It's a lot of tools.
It is. But underlying it all, and maybe most importantly, is the psychological discipline and the strict risk management, especially that position sizing piece.
So, for you listening, maybe think about how those seasonal ideas could add another layer to how you view sectors. Check out those free sentiment resources, AII, COT, to see what they're showing.
Yeah, and maybe experiment with adding something like OBV to your chart. See if it confirms or contradicts what the price is doing. Does it add value to your analysis?
But most fundamentally, really think about your own risk tolerance. How much are you truly comfortable risking per trade? Getting that position sizing right is probably the single most important thing for protecting your capital long term.
Couldn't agree more.
Okay, here's a final thought to leave you with. In this market, always changing, driven by tech, by fast shifts in sentiment, maybe the real edge comes from connecting the dots.
How do you mean?
Like taking these different pieces, the seasonal patterns, the sentiment extremes, the technical signals from OBV or MANZD, and seeing how they fit together, or maybe where they contradict each other. What connections can you start making between seemingly unrelated bits of market data to find those hidden opportunities, or maybe spot risks others are missing?
That synthesis, that constant learning and adapting.
That's maybe what mastering the market is really about. Keep thinking, keep learning. Thanks for diving deep with us today.